Hello and welcome to the Trading Zone. I am Joe Teague, your host of Equity Armor Investments, also the portfolio manager of the Rational Equity Armor Fund and the Catalyst Hedged Equity Fund. With me is co-portfolio manager and also of Equity Armor Investments, Brian Stutland. Brian, how are you doing today?
Great. We got a new week ahead here. Gold ramping higher, up almost 3% today. Markets obviously had a very volatile session on Friday with concerns about where the China-U.S. trade negotiations are going. And so we've had a lot of back and forth actions. The market is up as well today. So we're going to be discussing all that and obviously some pretty big, huge volatility swings, especially in the VIX. First segment of the show here, we'd like to get into just what we're talking about here on volatility. Here at Equity Armor Investments, we're both former traders on the floor trading VIX options. So our specialty is talking volatility. And in fact, you look at this and yes, Joe, we've been talking about this for a while. It had been too long since we had seen a VIX spike, and the day was probably coming to reckon. As you see, every few months we get this spike. Maybe every year you get a really super spike. So at least we got a little mini one that took place on Friday. And volatility backing off today when the markets rallied, saying, Trump basically saying, "Oh no, things are going to be okay with China." I'm not too certain about that. We'll see how this plays out. China never goes quite that quiet. So, what are your thoughts, Joe, here on what we saw on Friday's VIX spike?
Yeah, like you said, this had been coiling for some time. We've been saying, hey, it's been a long time since we put a new arrow on this chart. Finally got it, of course. A big rebound today. We'll see if that holds. Maybe it's going to come down to the bank earnings tomorrow, Brian. We're going to get some bank earnings. We don't have economic data because, by the way, through all this, the government's been shut down. Nobody seems to care about that. But maybe these banks will tell us how the economy is looking because we don't have the data coming from the government.
Yeah, it's crazy. I mean, just nobody cares. The government shut down. It just seems like there's no talk about it, whether it's going to sort of complete itself, figure itself out. But certainly,
my thought on that, Brian, is that historically it's just okay. It shuts down for a week, 2 weeks, maybe 3 weeks is would be really long, but we'll get back. No big deal. And the market's kind of pricing in that it's going to be reopened shortly. I'm not really so sure if we've seen any signs that we're going to be reopening imminently or shortly. And I kind of think maybe it's going to take some economic shock or some job losses or some damage coming through for them to get to for the parties to meet here in the middle, which is what it's going to take apparently. So that is maybe just another risk on top of everything else, which we are always watching very closely.
Yeah, and as we look here, that's kind of interesting here, the MOVE index, because we've been talking about this with bond volatility, and we finally saw an uptick here in the MOVE index. And so certainly that has some ramifications on how people value stocks. We've talked about the lower the MOVE index goes, the higher valuations on stocks can go because there's just more liquidity in the system. And if we get a little carpet shakeout, do you see it going anywhere further higher, or is this a one-day blip out shake?
Just, another thing to be watching here, it is interesting to see that it's still kind of higher today, even though volatility in the rest of the market is lower. But yes, this was a big rebound higher. There's no question about it. But boy, we are still much lower than where we were early in the year. It doesn't kind of look like the VIX chart where we were like flat and then went higher. We've just been trending lower here. So, I think above this 90 area, above this area is where I would start to say take more notice. And maybe it just can go up here with very little resistance because this is really low volatility for this. But all that said, it's just another sign. Yes, the Fed will be lowering rates. The Fed is adding liquidity. The Fed's not alone in adding liquidity. All these central banks around the world are adding liquidity, lowering rates. And that's just another reason why we're seeing gold making all-time highs while the markets had a little bit of a shakeoff last week.
Yeah, and I think some of that comes from it was looking like the overnight lending rate was trading a little bit higher than the Fed funds rate. Typically, it's kind of in line. If it's really on the high end, it's overnight lending is like 10 basis points higher than the Fed funds rate. And we've kind of gotten to that level. So maybe that's, creating some volatility in the bond market because the Fed is not really there like it was maybe call it 2 years ago, 3 years ago in terms of overnight lending and liquidity. So their pullback is having some effect. We turn and look here at the skew index, which measures the downside put towards the premium of it relative to the upside call on the S&P 500. And you can see there's been an uptick here. Obviously, we did see some put buying that's created some heightened volatility in the VIX. Downside puts are very big actually right now. Even very short dated, 1 day, weekly kind of options. There is some nervousness that there's a big downward move. I'm kind of in the camp that maybe very downside put can be kind of sold. I'm never big on like selling a 10 delta or 5 delta put, but short term, it's pretty far away and there's still some value there as small as it is. And so, yeah, I think there needs to be like one more event to like really get people freaked out. I'd rather own maybe like a 30 delta put, if anything.
Yeah, I think, and we're kind of in the stage where there need to be more of like a credit risk or something to see this volatility pick up anymore, or a bigger reason for people to start selling stocks than they already have. If we do continue to have a little bit of a meltdown, if we are just kind of at like the top of the market and just going to melt down just a little bit, 10% type of a sell-off, volatility might be appropriately priced for that. And be hard to go higher. We're going to need some sort of like contagion or reason for the things to pile up on top of each other. It could be the economic shutdown. It could be a tariff thing. So the risks are there, but we have not seen it yet. Again, eagerly look forward to the the bank data coming, or the bank reports, earnings reports coming tomorrow. In the VIX futures curve, we're seeing, of course, elevated cash VIX. The from a future trading below it this morning. So certainly futures traders are expecting this volatility to come down in the very near term here.
Yeah, it is interesting that the front month VIX future October is trading below where the VIX is, indicating that, like you said, VIX maybe comes down a bit. We obviously have some mean reversion. If you look at it a week, a month, 2 months ago, VIX futures obviously a lot lower. So those will kind of act as some sort of magnet to pull VIX maybe down and not let it expand so quickly to the upside out of nowhere. And so that's something really kind of that I'll be watching. I will say though, if that skew kind of tilts and we see these put buyers kind of come back in on the S&P 500, that could rush the VIX significantly higher and put us, VIX upper 20s very quickly. So I'm watching really the downside activity in puts on the S&P 500. That'll be really my indicator on whether how strong this VIX can spike higher or whether these VIX futures will just come off and, kind of contract back to the mean reversion where they were before.
Yeah. Any way you slice it, right now we have, compared to the recent months, heightened elevated volatility here. Mean reversion suggests lower, but look out for this future. I guess if volatility does go higher, there's a lot of room for this future to run here. So that is the interesting thing about these futures. Of course, we all know that. All right, Brian, looking forward.
Well, I was just gonna say that wraps up the volatility portion of the show. As we turn the page here, we've obviously have a lot of things on tap this week to sort of keep an eye on. We really want to get into our big picture trade of the week and what it looks like maybe a month out from now, where we want to position ourselves either in the S&P, gold, Bitcoin, lots of things going on to trade that we'll talk about. Joe, you mentioned bank earnings. Yeah, they're coming up this week. Should give some insight on that liquidity picture on that move index that we talked about in our volatility segment. And then obviously the geopolitical trade uncertainty is just going to be, tremendous swings back and forth depending on what kind of news we get out of that.
Yeah, and we also have a little bit other earnings too. Netflix, kind of an interesting one to me. How is the consumer discretionary spending going out there? Are they just the most inelastic good where it doesn't matter what price it is, people will still pay for their Netflix? I think they might be. It's becoming an essential, just like gas and electric and water and Netflix. It's just a utility people have to have in their homes. So today, getting a great bounce back in the market. Big sell-off, as we know, happening on Friday. It happened across the board. Nowhere was free to hide. You had the NASDAQ of course, having a big sell-off, just massive sell-off in the semiconductor index, really, really strong pullback. Of course, the Mag 7 experienced it too. And we're having a great rebound today, but for me, it's just kind of like the magical spot right here. Yes, we're rebounding here, but is it just a little bit of a dead cat bounce where we're going to see this disastrous bank numbers or data tomorrow? Going to realize this economy looks really weak. That's why the Fed's cutting rates. Tariffs are really crushing companies, and they're not able to pass this tax on. Really big questions here coming with earnings coming up in the short term.
Yeah, I would say that maybe the one concern, if you just kind of look at that chart there on the Mag 7 while you have it up, is like a little bit of a double top-ish formation, just very short term. We've kind of gotten back to like retest where it broke down. So I kind of want to see it push through there. Did it kind of coincide? That's kind of interesting. The sell-off from Friday down from where the high was on Friday down to the low, we actually traded on the S&P E-mini right to the 61.8% Fibonacci retracement for those technical geeks out there. It kind of hit that right at 67.04, I'll call it, and backed off. So I'd like to see that level sort of, bounce above if we're going to move higher here. And then, Joe, you just pulled up a chart real quickly here on comparing where we are now to where we were in the 90s. We've talked a lot about this, Joe. The bubble, are we in a bubble? Are we at the end of the bubble? Where's it going to pop, burst? You say we're right there. Why?
Yeah, remember this chart is coming off of like when the Fed started their easing cycle. I'm saying a lot of this bubble action is happening because of the liquidity and easy money coming from central banks, most importantly, the U.S. Central Bank, the Federal Reserve Bank. And yeah, the Fed cut rates in 95, cut rates last September in 2024. And we're right here. This was a huge, of course, rally. We had lots of, divots here in the 90s we need to remember. So if we do have a 5-10% pullback, it's not really the end of the world or the end of the rally. And at some point in this rally, it's very possible we could get a huge inflush of cash coming in here from central banks around the world. This happened, of course, in the 90s with the Asian debt crisis, the Russian debt crisis. We cut rates again. The world just flooded cash, fiat onto the system. And yeah, we saw this. So that's certainly possible. Maybe it's not necessarily going to time up perfectly with this. It's very unlikely that it will, of course. But I think anytime we're adding liquidity into the system, we're just going to see this fuel to the upside. And of course, people out there were saying, hey, we're watching gold, by the way, which we're going to get to in just a second here, Brian. People out there were watching Bitcoin and saying, hey, I want to play this anti-fiat narrative. I want to get in on this game. And you're probably going to be right in the long run if you're holding Bitcoin. But what you don't want to do, which is what a lot of traders got suckered into last week, was have some leverage on and putting on more than they can hold on Bitcoin. And we saw a lot of people blowing out on Friday on just like one big sell order. A lot of trades flush through the system. A lot of alts got hammered through. So leverage is going to be the way if you buy and hold Bitcoin and you see it, you have, $1 million, projections, 2 million, whatever the case may be. If you just buy and hold it, you're going to do just fine. If you buy with leverage, keep on adding on it with leverage, you're going to go broke eventually. So that's kind of the narrative. It's a story I wrote up on our blog today about the golden goose and the farmer. A farmer, if you can believe it, Brian, had a goose that would lay a golden egg, and that would make plenty enough for the farmer to feed and have enough money to protect his family. But the farmer said, hey, there's a lot of gold in this goose. What if I kill the goose and get all that gold immediately? I'll have all this money right away. That's kind of what leverage trading is. So, of course, the farmer killed the goose. There was no gold in the goose. And instead of having a golden egg every day, he had nothing. So that's kind of the story with leverage. I don't want to jump all in, put all my cards on the table just for one event. I just want to let it play out slowly.
Well, I think, and we'll kind of get into this now too, talking about the gold picture, because if you really look at Bitcoin and the NASDAQ 100, those two have really kind of moved together for the last like almost a year now, actually. So Bitcoin being more of just a leverage play on the NASDAQ. So if I want to own something for real, I'm going to own the NASDAQ. I'm not going to necessarily own Bitcoin. The shift has been right here in gold, where if you're playing anti-fiat, it just seems like recently there's been a big move from gold to be the anti-fiat currency now as a play to the upside. And, we talked about this earlier, gold up 3% today almost. It's really taken off. It obviously had a huge just kind of sideways move. And ever since we sort of had issues with tariffs and issues with our debt continuing, now we have a government shutdown. I think gold really likes a government shutdown because it basically devalues the backing of the U.S. government. So it's taken off. But Joe, do you see this becoming kind of bubblish almost to a degree, or is it foreseeing this crisis, this credit crisis that's going to happen maybe a year or two from now, like in '98, where the Fed's going to have to cut interest rates, they're going to have to keep lowering rates, and gold is going to be in favor? Is that predicting that, or is it just getting bubbly?
Well, at some point it's going to pull back. It is rising super quickly. And remember, I think the problem with gold is that, it's beautiful. It's nice to hold. It's a great store of value, but you can't really do much with it. Yeah, maybe a little bit of cosmetic use, but it doesn't have any practical use. And I think at some point, if there is like an economic slowdown, people will have to raise cash and get cash to do things that they need. So that's really been kind of my one problem with it, because we're not really. Yes, I am expecting to see like the central banks start to prop up all assets, but you're not really seeing that across the board. Of course, we've been talking about oil a lot lately, but we're not really seeing all assets being propped up. We're not really seeing a full-on crack up boom. This is kind of looking a little bit more and more like a bubble to me. And people are just kind of looking out, and here's like a 5-year chart of gold, of course. People are just kind of looking out and saying, I don't want to necessarily own asset prices at these PE ratios. I'd rather have my money in a safe harbor. I don't want to own cash because we know that's being devalued. I want to stick it into gold at some point. And that the thing about bubbles is and markets, they are more often than not irrational than you can remain solvent. So at some point this will crack. Maybe this will go on a lot longer before it does pop, but this absolutely is looking like a bubble formation to me.
Yeah, I mean, that move is insane, really, when you think about it. Like 2024, gold was sitting near 2,000, and then just 2 years, it's basically doubled. I guess, I mean, does it mean that the U.S. dollar is just continuing to weaken? Is our debt too much? Like, that's pushing gold this significantly higher? Are interest rates too low and inflation is real, and that's why gold is so high? And there's definitely some validity to that, in my opinion, that's a reason to push gold higher. But to be 100% higher in 2 years on something that's just a means of transacting, I don't know, whatever.
And by the way, we've been bullish on gold for a very long time. I'm not saying it's going to turn around right here. I'm very cautious right here, though. It's not a position I'd be adding extra to. If I had a 3% to my portfolio allocation, I'd be trimming it here, saying, hey, I want to get back down to 3% because this is a little bit lofty. That said, again, I'm not saying it's going to turn around here. It could absolutely continue higher for a lot more. But yes, you mentioned the dollars going down in value, but the dollar is measured against other currencies, and all those other currencies are also going down in value. So it's just like kind of a race to the bottom. What do I want to own? Gold is the answer for a lot of people who are not looking for risk. I think you will see this cash or this proceeds here be pushed back into high risk equities, back into the big cap tech once this kind of peaks out. Maybe start to see some consolidation here in gold.
Yeah, I would say, I mean, unless there's some catastrophe coming, like a year down the road, like a '98 kind of credit crisis scenario, it seems a little overdone. We did on the breakout up from 3,500 to 4,000. We did actually add this to our model portfolios that we do for individuals. Joe and I, we manage individual client money here at Equity Armor Investments, and so we did add that into the portfolio on a momentum breakout. But now the move seems a little bit too much. We may ease back on it. I'm not taking it off the table today because I don't want to like run in front of a freight train here, but it probably seems maybe prudent to back it back out of our models, or like Joe said, dial it down. We take a look at crude here. Obviously, great news coming out of the Middle East. With at least some peace talks occurring, hostages being returned to Israel. So a great day for that country to get their people back. Such an unfortunate event that took place almost 2 years ago now.
I think it's
actually over 2 years ago.
Region, the big oil producing region in general, it's better prospects for peace with Iran at this moment too. Less likely to be fighting them at this point. So yeah, I do think that plays into the big picture. Of course, closer relationships with the U.S. and Saudi Arabia and this area. So yeah, I think this all plays into why oil is not running away. But it might also be, we should expect oil to be higher with the inflation. It might be the economy is not as strong globally as we thought. So that's another potential just nugget out there. We'll be watching closely, of course.
Yeah. All right. Well, that wraps up kind of our big picture part of the show here. I want to get into our trade of the week. Joe, you have the trade going this week. A couple different ideas. We've been pretty hot lately. So
yeah, we've been in fuego lately. Brian had a couple of Oracle trades. This was last week's Oracle trade. Real quick, I thought Oracle's price action last week was just phenomenal. The market was collapsing. Oracle hung in there. It looks to me like it wants to come a little bit higher. I said maybe a potential possibility last week, Brian, was to come right back up here to this 340 area and then do something like that before going higher. That's why my last week's trade design was this leverage long Oracle. We sold this December 282.40 put spread. We bought the 300 340 call spread. We got to collect 30 cents last week. Today, this morning, it is $6. So a great trade on that front. Really loving that action. Want to look at something we talked about last week was AMD. Now, at the start of last week, everything was rosy-dozy for the semiconductor stocks. AMD was leading the market higher with the big OpenAI deal. And what did I say then, Brian? Just like on the Oracle news with OpenAI, don't go and buy this rally here. Wait for the pullback. Got a great pullback on Friday. I'm ready to buy AMD, by the way. So let's jump into it. What do you say?
Yeah, I mean, it's shaping out very similar move like Oracle, like a big gap, huge, massive gap up on earnings or deals being made, an influx basically of more new revenue coming in. And this looks a lot similar to the Oracle trade, right? Where you're going to sell a put, maybe buy, finance that to buy a call spread after it's baked off from its highs, pick some levels where you're like, okay, I'm comfortable owning the stock down at some levels here. So what do those strikes look out? You look at the technicals there, 240 on the upside, 180 on the downside as support.
You nailed it. Yeah, that's exactly what I'm looking at here, Brian. We dip back down to 185. I am saying, hey, this is a buy. Absolutely huge run up here. I don't think this was unfounded, this run up. I really love the comments from the CEO. She was saying, we're just scratching the tip of the iceberg of what is going to be demanded in the next 2-3 years. I think that's phenomenal news. I think this chip market is expanding out beyond NVIDIA. I think it's just great for everybody involved. So bottom line is, yes, if we do pull back here in the short term, I 100% want to own AMD. And I think we're going to see something similar to Oracle, where we're going to trade back up and test this level. That is exactly why the trade of the week is as follows. So the December 19th expiration 185 put, buy the 220, 240 call spread, very close at the money there, and I will collect 30 cents.
You like that 30 cent number there? I thought you were going to go with something that's 67 cents, 6-7. Isn't this our 67th show at Equity Armor here with Tradier? So I thought you might play the numbers there, but we'll go back to the well, and that collection of 30 cents worked well for Oracle. I think it'll work well again. Thanks everybody for tuning in this week.
Wait, there's more. Don't you want more? There's a bonus trade.
Oh, there's a bonus trade. I didn't know we had a
bonus trade. There's a bonus trade. Hold on. We're coming back here. There's two trades today. Going back to the theme here, if Oracle is going to be having these data centers, if AMD is going to be selling these chips, one thing that has been missing is, wait a minute, if all these data centers are coming online, we're going to need some power to go along with it. One company already with deals with Meta, already with major deals out there to supply these mega data centers, which are coming online, is Constellation Energy. They are kind of high beta utility, if you will, which means very high volatility for a utility company. But for me, there's no question we're going to need power. Even if they don't get new deals, they're still going to be just fine over the short term. But I think given the high level of volatility, given the fact that I expect the market to continue to go higher, and I also think that 400 is going to be an area which might stick around here. Given that little tidbit of information, can you guess where I'm leaning here on my trade?
If I was looking at this chart on a breakout like this, probably going to do something similar to the Oracle AMD trade. However, may want to leg into it. I'm almost willing to just buy a call.
Just really looking at this 400 area.
All right, so if 400 is your target, you got to probably buy a call spread, because I like about owning an at-the-money call on this thing, just outright.
At-the-money call would be a great idea. I think volatility is just astronomical for a utility company. That's why I chose on the cheaper route to outlay less capital, the Melt Up Butterfly, where I'm going to be buying November expiration, November 21st, buying the 380 call, selling 2 400 calls, and then buying a 420 call. And I can get into that for a little bit more than 67 cents for 250, two double, if you will. I think that's, for me, a cheaper way to buy a call. I'm not expecting this name to race through to 420 immediately. It's had an amazing run, of course, up 70% on the year. But I think more and more melt up is in order. A cheap way to get into this from 380 to 400 for the next month and a week is exactly this.
Well, I think on this trade, we will definitely update this trade. If you go ahead and subscribe to our trading zone and pay our monthly subscription fee, we update trades all the time. This is one that's going to need to get updated, because if CEG gets through 400, this trade kind of turns into like a positive delta to a slight negative delta, because it really kind of wants the whole price to price out to shake out and pin right at 400 by November expiration. So with only a month to go, it seems like the strikes are wide enough here where we've got some time and wiggle room to sort of play around with it. But this will be a trade that, will be needing update. It is a very cheap way. Look at that. I mean, $2.55 is less than 1% of the value of the stock to play an upside sort of delta to CEG. I love this play. If you're just looking at the power market, electricity costs have been going through the roof. I think what needs to happen is, and I would love to see local governments really kind of get involved, is that it's, as we build out data centers, I think it needs, as part of the build out, needs to be required that these data centers can be self-sustaining electrical consumption centers, right? So in other words, what has to be attached to these data centers is its own sort of power source, so that we're not sucking energy from the grid that we would otherwise need. And then we're going to get into a whole, AI versus humanity kind of scenario of as doom and gloom. So let's get ahead of that and give these data centers what they need. And CEG is going to be a huge beneficial factor if that ever goes that route. And I think it will go that route. I'd love to see governments kind of getting involved. I'm more on the conservative side of less government, but this is one I think should be required. Because if you're just building data centers, you're just creating massive inflation if you're not, also increasing supply. But in any event, I like this trade. Great bonus trade, Joe. Thanks for the surprise on that for everybody. Hopefully everybody stayed in to tune in. Make sure you tune in every week, though. Every Monday, right here at noon. You can sit here, eat your lunch for the first half hour of your lunch, listen in, get some great trade ideas. We're hot right now, Joe. So I think, people got to stick with us. But go check us out, equityarmorinvestments.com. You can sign up for the Trading Zone subscription newsletter. Also check out some of our other products, individual advising, or also our mutual funds, which have performed very well. I believe the Rational Equity Armor Fund outperforming the S&P as of Friday's close, and yet less volatility because we hedge the downside, right? So go check that out. Check us here at Equity Armor, YouTube, like, subscribe, and we will catch you next Monday at noon Eastern. Catch you then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.